Hello, and welcome to the next video in my series on basic accounting concepts. Now, just two reminders before we get going. Number one, these videos are geared towards individuals who are relatively new to accounting. So maybe a high school student or an undergraduate student that's taking accounting for the first time, or a small business owner that would just like to know a little bit more about basic accounting. Two, if you're watching this video on YouTube, please refer to the description below the video. In the description, you will find a link to the corresponding blog post for this problem. On the blog post, you will find a link that will allow you to download a blank version of the Excel file I'll be using in this video, so you can pause and follow right along step by step, since that's how we learn best. Alright, let's go ahead and dive right into today's topic. Now in this video, we will be talking more about integrated financial statements, and more specifically, the accrual accounting concept. In my previous videos, we talked about cash accounting, but in this one, we're going to talk about accrual accounting. And I'm going to begin by giving you a few examples, and then we're going to dive into Excel to look at a more complex financial statement, and hopefully you'll have downloaded the file and can follow right along. So here is an example of accrual accounting, or at least an example you may have come across in your daily experience. So let's say you venture to Best Buy, assuming the one near you is still open, on June 30th to purchase a big screen LCD flat TV. Now, to gain frequent flyer mile benefits, you use a credit card, even though you have the cash available in your personal bank account. You go ahead and use the credit card anyway because it has the benefit of frequent flyer miles. If you go in and do this transaction in the Best Buy using your credit card, what just happened in simplified accounting terms? So here are some questions we can ask. Did Best Buy actually get cash during that sale? Not really, because you used your credit card, right? So you did not hand them $1,000 in cash or whatever it cost, and you didn't really write them a check, which is more or less considered cash. You used your credit card. So that's going to have to go through a certain process before they actually get the cash. When does Best Buy record the sale or the revenue? Now remember, it's June 30th. It's the last day of the month. Does Best Buy record that sale in June? Or do they record that sale in maybe July when they get the payment from the credit card company? When do you actually pay for the TV? So if you use a credit card, have you actually paid for the TV? Well, next month you're going to get a bill from the credit card company with that purchase on it. Now if you pay that balance in full, then have you paid for the TV? And finally, when does Best Buy actually get the cash for the sale? So if you use a credit card, it goes to the credit card company, and then maybe once a month, I'm not exactly sure how it works, the credit card company will send Best Buy a check or deposit or whatever it is for the sum total of all purchases made using that credit card vendor. So when do they actually get the cash? It's probably not going to be right away, right? Now, the answer to a lot of these questions depends on what form of accounting you're using. You know, if you're using cash accounting, it's all going to be about when cash comes in or out. If you're using accrual accounting, it's going to be about when the revenue is actually earned, when the TV walks out the door. But notice the common word here, when. When does Best Buy record the sale? When do you actually pay for the TV? When does Best Buy get the cash? The focus on accrual accounting is all about when. So let's compare these two accounting schemes side by side. In cash accounting, it's actually pretty simple. All revenues are recorded when cash comes in. So it doesn't matter, nothing else really matters. It's only when cash comes in. Expenses occur when cash goes out. Pretty straightforward. Now, because we're just working with cash in and out, there are no adjustments we need to make. It's kind of like doing a checkbook. Cash comes in, cash goes out. Now, how about accrual accounting? Well, in this case, revenue is recorded when it is earned, not necessarily when cash comes in for it. It's when it's earned. Expenses are incurred when generating the revenue. So as we earn revenue, we match the expenses that were needed to generate that revenue. And in accrual accounting, we have to make adjustments. And in our examples, and especially in our spreadsheet, you're going to see some really, really good examples about how we do that. So here's a very quick example, and this is actually from my personal experience. So let's say you are the neighborhood kid who mows lawns at $25 per lawn. So one day you mow 2 lawns. The first person is home, and of course they pay you. They pay you $25. But the second person is not home, and therefore they cannot pay you that day. They're going to have to pay you sometime another day. Now the question is, what is your daily revenue using cash accounting? What is your daily revenue using accrual accounting? Well, if you're using cash accounting, your daily revenue is $25 because that's all the cash you actually received. However, if you're using accrual accounting, your revenue is $50 because you're counting the revenue when it's actually earned. So just this very simple kid mowing lawns example can show us the stark difference between cash accounting and accrual accounting. So let's talk about a few other examples. Now, I admit 1 or 2 of these are a stretch, but I want you to get the idea of timing, okay? So here's one. Think about the time between when you order a meal and you actually pay for it. So let's say you go into Outback Steakhouse and you sit down, you order a nice big juicy steak, and you sit there and you eat it. It's great, it's fantastic, and everything else. Now, up to that point, the restaurant has incurred a lot of expenses. They have paid the cook, they have paid the serve staff, they have paid the electricity while you were there, they have paid whatever else, okay? So the restaurant has incurred expenses to make what you have just eaten. You, by eating it, have taken on an obligation to pay for it. But let's say you eat it and you look in your wallet and you're like, oh my gosh, I don't have any money. I forgot my credit cards, my bank card, or I don't have any cash. I don't have anything else. So I'm going to dine and dash, and you just leave the restaurant. If you think about that, obviously that's bad. You wouldn't do that. But there are a series of incurred expenses and obligations and things like that that have happened there. So the transaction really is not consummated until you actually pay for the meal one way or another. Number 2, the electric company sends you a bill for your energy usage. So you use a certain number of kilowatt hours during a month, and maybe the power company comes by and reads your electric meter, they write it down, and then they send you a bill for the difference between the last reading and the most current reading. So what has happened here? Well, the electric company says, okay, you've used this much, and they print up a bill, maybe it's like $125 or so, and they mail you a bill. Well, to them, they now have an asset. They have an account receivable because you are now legally obligated to pay them $125 for the electric. So you get your bills together, and there's a period of time between when they write the bill and when you actually send in the cash to pay that bill. So that time difference, okay, is something we account for in accrual accounting. Now, the electric company is going to book that revenue when they print up your bill. They're not going to book that revenue when they get your payment. And that's one of the characteristics of accrual accounting. Number 3, this will be the primary example in our spreadsheet. A doctor bills an insurance company. So you go into the doctor, you have whatever procedures you're going to have done, you might make a co-payment, and then your doctor's office sends the bill to your insurance company. And then there's some time lag in there, and then the insurance company will reimburse the doctor for all or part of that, and then whatever they don't, the doctor will bill you for the difference. Now, when does the doctor actually record that as revenue? Well, the doctor's office is going to record that revenue the day you walk out of the doctor's office, because that's when the service was performed. That's when it was earned. So the doctor will not wait to book that revenue when the insurance company sends him or her a check. Okay? So it's not about when the cash comes in from that bill, it's when the actual service was performed. Businesses buying supplies on account. So a lot of businesses have relationships with office supply stores and things like that. So if they need some supplies, they can either order online or from a catalog or go into the store, and the business just charges their account, and then probably once a month sends them a bill for whatever purchases they have made during that month. Now, when does the office supply store book that revenue? Do they wait for you to pay your bill? No. They book that revenue when you walk out of the store with the goods, or they ship the goods to your business online or whatever. They don't wait for your payment. And finally, selling a car using financing. So if you go into a car dealership, and let's say you buy a $20,000 car, maybe you make a down payment of $5,000, so the rest of it, the $15,000, you're going to have to finance. So how does this work? Well, the dealership, he does the credit check and everything to make sure you have good credit history, and they find a loan for you, and then you sign the loan documents, and you leave with a car. So you walk off the car lot with a $20,000 car, but you only gave them $5,000. So what's going on here? Well, the other $15,000, the dealership has worked with the finance company, so they'll send the paperwork to the finance company. The finance company will send them the $15,000, and then you will pay back the finance company with interest for that $15,000. Now, when does the car dealership book the sale? Do they wait for the finance company to give them the $15,000 that you didn't pay? Well, no. They book that sale the day you drive off the lot in the car. And then eventually, the $15,000 will come in from the finance company, and the dealership is made square, and then now the relationship is between you and the finance company. So you can see that there's this difference between when the service is provided and when the cash actually comes in or out, depending on if it's an expense or a revenue. Okay? So you have to keep in mind the difference between when things occur and when the actual cash transaction occurs. All right, so let's go ahead and dive into Excel to record and discuss transactions within an actual integrated financial statement. And we'll be using the doctor's office that we used in our previous videos. Let's go ahead and dive right in and do some accrual accounting. Okay, let's have some fun. So here we have our integrated financial statement in Excel. Now, 2 notes before we get going. You will notice that this is a very large spreadsheet. It's almost 50 rows deep, and that's just the nature of the problem. I can't do anything about that. Now, to make sure you can see everything, I have recorded this video at my maximum screen size. So for me, that's over 1900 pixels wide. So you can open up the YouTube viewer as large as you want, so you can see every cell and the data we put into each transaction. Number 2, there were parts of the spreadsheet we're not going to use in this video. There are certain rows that are actually intended for our next video when we talk about making adjustments to these transactions in the future. So when we get to the end of the video and there are a few empty rows, don't worry. You're actually going to see them, hopefully, in our next video. So, all that being said, let's go ahead and dive right into our problem. Now, this integrated financial statement is set up just like our previous integrated financial statements. We have the balance sheet along the top. So we have assets equals liabilities plus equity, which is our fundamental accounting equation. I have color-coded each one so it's easier to see. And you will notice that as of right now, we actually have some opening balances. We have about $7,000 in cash. We have land that's valued at $12,000. We have a note payable, which is actually the loan on that land, of $10,000. We have capital stock of $6,000, which is Dr. Landry's initial investment. And then we have retained earnings of $3,320 from our previous month. So that's where we're starting. Now on the lower left, you will see our statement of cash flows. We have a beginning cash balance, which matches what we have at the top under assets. And then anytime we make a cash transaction in this video, it will also appear in our statement of cash flows down there at the bottom left. In the bottom right, we have our income statement. So when Dr. Landry earns fees for providing medical services, they will appear there under revenue. And when the office incurs expenses like wages and utilities, we will record those under expenses and they will appear in our balance sheet. So everything is tied together. And remember, that's the entire point of having an integrated financial statement, because the income statement, the cash flow statement, and the balance sheet are not individual, they're not separate. They're all tied together in unique ways, and the whole point of entering these transactions is seeing how different statements change when we do accounting. Now, in the middle there at the bottom, you will see that this is my error checking formula, and this always checks to make sure a balance sheet is in fact balanced. So it will not catch me if I put something in the wrong row. However, that tends to get fixed because you notice, wait a minute, that shouldn't be there. But it does keep me from going on to the next transaction without actually balancing out our balance sheet. So that's the layout of our integrated financial statements. Let's go ahead and dive in and start making some transactions. Now each transaction is listed on the left-hand side, A through L. Those are the ones we're going to pay attention to in this video. And they correspond with the statement of cash flows and the income statement by the lowercase letter. So our first transaction in this problem is receiving some rent in advance for the use of our land. Now remember, we purchased land that's valued at $12,000 because we plan on developing it at a later date. But we are shrewd business people, and we don't want to let that land sit there without doing anything for us. So we have agreed to enter a contract with another company whereby they're going to pay us in advance $1,800 to use our land as a temporary parking lot for the next 5 months. So that way, at least our land is generating something for us, and they have a low-cost solution to their parking problem. So they're going to pay us $1,800 in advance to use our land. So we have a cash transaction of $1,800 that's coming into us. Now, how do we balance this out in our balance sheet? Well, is it equity? No. We haven't, we haven't even done anything yet to earn it. It's prepaid. It doesn't really fit there. So where does it fit in our balance sheet? Well, this is revenue that has been prepaid to us, but we haven't done anything for. So this is called unearned revenue, and it goes under the liability section of our balance sheet. Now, why is that? Well, if you think about it, that other company paid us $1,800 for the right to use our land as a parking lot for the next 5 months. So they gave us cash prepaid, but now we are obligated to allow them to use our land as the parking lot. So if we were to cancel the contract, we would have to give them back the cash they gave us. So we have the obligation, the liability, to let them use the land. So that's why it goes under unearned revenue. And it's unearned because it's prepaid. We haven't really done anything yet to actually earn the revenue. Now, after the first month, 1/5 of that will become earned revenue because we've actually provided the service for that month. Now, along with that, if you look down at our statement of cash flows in the lower left, you will see we have an operating cash inflow of $1,800. And that is the $1,800 they gave us to use our land as a parking lot. Okay, so we're on to transaction B. In transaction B, we are paying for an insurance policy that will cover our business for the next 2 years. And this covers things like fires, maybe someone injures themselves, or there's water damage, I guess, or anything that can happen to our business. Now, we are paying that insurance up front, and it will cover us for the next 2 years. So how are we going to represent this in our balance sheet? Well, the policy cost us $2,400. So we're going to have a cash outflow of minus $2,400. Okay, now you know we have to balance that out in our balance sheet, but where is it going to go? Is it a liability? Do we owe anyone anything for that? Well, no. Actually, we have something, valuable. We're not owing anyone anything else. Is it equity? Well, no, it's not earnings or capital stock or anything like that, which means we're going to have to balance it out all on the asset side of our balance sheet. So we paid $2,400. What do we get in return? Well, we got $2,400 worth of prepaid insurance. Now remember, a transaction doesn't always have to balance out on both sides of the equal sign in our balance sheet. It can balance out all on one side. And in this case, we're just taking the cash asset of $2,400 and switching it into an asset of prepaid insurance. We're just converting an asset. Now, if you look on the lower left of our statement of cash flows there at the bottom, we do have an operating cash outflow of minus $2,400 because we did have to pay cash for that insurance policy. But our balance sheet is still balanced because we balanced it all out on the left-hand side. We just converted one asset into another. Now, in transaction C, we have another prepaid insurance. And this is our malpractice insurance, which is really expensive. So for 6 months, this malpractice insurance is going to cost us $6,000. So we have a cash outflow of $6,000 for the policy. And again, we have prepaid insurance that is worth $6,000. Think of the insurance company in this scenario. They've received our cash, right? So they would have a cash asset from us, but they would also have a liability, and that is they have to provide us insurance for the next 2 years or the next 6 months. But on our end, we're just converting one asset, cash, into another, prepaid insurance. So in a way, we are obligating the insurance company to provide us insurance. Now, if you look in the lower left, we do have a cash outflow of $6,000. That's what we just paid for this insurance policy. So we've spent quite a bit of cash up to this point. Now, in transaction D, Dr. Landry has decided to invest $5,000 more into the business. So we're going to have some cash coming in, which is nice. And he has decided to invest $5,000 more into the business. And where is that going to balance out on our balance sheet? Well, if you know anything, from my previous videos, you know that when someone invests in the business, especially when he's the sole owner, that he will get capital stock in return, even though this is a private company. So we have $5,000 of capital stock. And that just means that that's his capital in the business. It's nothing more really complicated than that. So we're all balanced out. If you look on our statement of cash flows, we have that $5,000 cash coming into the business, and we're ready to go. Now, transaction E, we need to purchase a small amount of supplies to make our business run day to day. So we are going to purchase on account, and this is the important part. We're purchasing these on account. So we have a relationship with an office supply store or business where we can go in and get whatever we need or order it in the catalog, and then they bill us for whatever we needed, and then we have 30 or 60 days, whatever it is, to pay for those supplies. So we're purchasing these not with cash. We're purchasing these on account. And this is the important thing about accrual accounting, is that not every transaction is based in cash. And when we talk about the next video, that will become even more apparent, and some further transactions in this video will also demonstrate that. So we are purchasing some supplies that are worth $240. So maybe we go in and get some printer toner, we get a stapler, we get whatever else we need for our business. That comes to $240. Now we have to balance that out in our balance sheet. Well, as you can imagine, if we walk into a store or go into a catalog and we take stuff, we're going to be obligated to pay for that at some point. So as soon as you hear the word obligation, you know that's going to be some sort of liability. And because this is a short-term liability, we record this under accounts payable. So by taking the $240 worth of office supplies, we create an obligation of accounts payable that we have to pay for those in the near future. And that's, of course, also worth $240. We're balanced out, and there you go. Now, interestingly enough, if you look down in the cash flow statement, what do we have for transaction E? We have nothing. It's a big black square. And why is that? That's because we didn't pay for this in cash. It's not a cash transaction. We're paying for it on account. So at some point, when we pay the bill, we will have a transaction in cash, but as of now, we don't. Okay, so now we're in transaction F. And for transaction F, we are making a large office equipment purchase. So this might be computer equipment, it might be furniture for the office, it might be whatever. But this is a very large purchase, and it is going to cost us $8,500. Now, we're not paying for all of it in cash up front, okay? So we have office equipment that's going to be worth $8,500. So we're going to have a new asset, or a new group of assets called office equipment, that have a value of $8,500. Now, of course, we got to pay for that, so how are we going to do it? Well, we're going to make a down payment on this office equipment that is $1,700. So we're going to have minus $1,700 under cash, and that represents our down payment. But of course, that's not all of it. We have to account for the difference, and we're going to be paying that in installments over the next several months. Now, when we're paying for something in installments over several months, we call that notes payable, just like our land loan there at the top. So we're going to balance this out by having a notes payable value of $6,800. So now, our accounting equation is balanced. We have a green OK there at the bottom. And what we've done is we've purchased some office equipment that has a worth of $8,500. We made a $1,700 down payment, but then we have to pay the rest, which is $6,800 over the next several months. So we have that obligation. We have that liability. Now, if you look at our statement of cash flows, we have a cash outflow of negative $1,700, which is the down payment we just made from our bank account. So everything is accounted for, everything balances out, and we are ready to continue. Okay, so now we're actually ready to have some revenue, because we've been laying out some cash up to now, so it's good to have some revenue coming in. Now, at transaction G, we have some fees for the medical services Dr. Landry provides, but he's going to earn these on account. Now, what does that mean? If you're lucky enough to have health insurance, you know that you, at least here in the U.S., you go into the doctor and you sign in, and they probably Xerox or make a copy of your insurance card, and it's pretty seamless. You fill out some paperwork maybe. You go in, and the doctor calls you in. You have whatever you need looked at. You have done whatever you need done, and then you leave the office. You usually go to the desk. You make a small co-payment to go along with your visit, and then the doctor's office sends the difference to your insurance company. Then, of course, the insurance company looks over the procedures that were done, figures out what it covers and what it does not cover, and then it pays the doctor back for whatever it covers, and then if there's anything it doesn't cover, it sends you the difference in the bill. So when we say fees earned on account, that's another way of saying that the bill was sent to the insurance company. And it's going to take a little bit of time for the doctor to get that money from the insurance company. So, in this transaction, Dr. Landry has done $6,100 worth of procedures that he has then billed the insurance company for. Why does that go under accounts receivable? Well, that money is an asset. It's owed to him by the insurance company. So even though he hasn't received any cash at all, maybe besides co-payments, but we're not talking about that here, but he hasn't received really cash yet. He just billed the insurance company, but it still counts as revenue. So if you look down in the lower right at our income statement, you will see fees earned of $6,100. However, if you go over to the statement of cash flows for transaction G, what do you see? Well, a big black square. Why is that? That's because there was no cash involved in this transaction. It's simply whatever Dr. Landry billed the insurance company. Now, of course, we have to balance out our balance sheet, so where does this go on the right-hand side of our equation? Well, it's not a liability, because actually Dr. Landry is the one who's owed here, but remember, it's revenue. So it goes under our earnings, our retained earnings of $6,100. So even though the earnings didn't come in cash, at least yet, it still counts as retained earnings. So our balance sheet is all balanced out. We have our fees recorded in our income statement. Nothing in the cash flows because, well, in this case, there wasn't any cash yet. Okay, now in transaction H, we do have some fees paid in cash. So for this transaction, Dr. Landry has $5,500 paid in cash because not everyone has insurance, and some people actually just go ahead and pay in cash while they're at the doctor's office. And this, of course, is also retained earnings, so it's $5,500 on the far right there. Now, if you look at our income statement, we have fees earned of $5,500, so we record that revenue there. If we go over to our statement of cash flows, we have operating income or operating cash flows incoming of $5,500 because those were done in cash. Now, the interesting thing about accrual accounting, or not interesting, but the thing to note, is that even in our income statement where we have two revenue lines, we have the cash fees earned of $5,500, but we also have our $6,100 that we billed to the insurance company. Only one of those is actually in cash. It does not matter in accrual accounting because we record as income when the services were provided, not when the cash actually came in for them. So that's one of the fundamental ideas of accrual accounting, so just keep that in mind as we go. All right, so we're down to transaction I. Luckily, Dr. Landry received a check from the insurance company, so he is being reimbursed for some of the procedures he has done. The insurance company sent him a check for $4,200. There we go. So he has a nice big fat check for $4,200 from the insurance company. Now, how do we balance that out in our income statement? What other transaction or what other column in our balance sheet represented what we had billed the insurance company? Well, that's our accounts receivable. Okay? So when the insurance company sent us $4,200, we have to reduce our accounts receivable by the same amount, so minus $4,200. So the insurance company owes us $4,200 less, and that's how we balance out that cash that comes in from the insurance company. Now, if you look in the lower left at the statement of cash flows, you will see that we have a operating cash inflow of $4,200, which makes sense because that's what the check was that we were sent by the insurance company. Okay, so now we're at transaction J. And in this transaction, we are going to make a payment on our account where we bought our supplies. You know, at the beginning of the month, we went in and got $240 worth of supplies, which is transaction E. And our supplier sent us the bill, and we've decided we're going to make a payment on that of $100. So how are we going to record that transaction? Well, we're actually making a cash payment. We're going to send them a check for $100. So we have minus 100 under cash. That's going to be our payment. But then we have to balance that out. Well, if we pay our supplier $100, that means we owe them $100 less. So we're going to have a liability that is reduced by $100. So if we go over to our accounts payable column, and again, that's the column that represents our supply purchase up in transaction E, we're going to be able to reduce that liability by the $100 we just paid. Okay, so we made a $100 payment on our supplies, so we have $100 less cash, and we have a liability that has been reduced by $100. We're all balanced out, and if you look at our statement of cash flows, you will see that we have a cash outflow of $100 for transaction J. Okay, so now we're at transaction K, and this will represent our expenses for the month. So of course every business has some expenses during the course of a month, salaries, utilities, and things like that. So we're going to record our expenses down on our income statement. Now for this month, Dr. Landry had $2,790 worth of wages, and that could be his office staff and things like that. He has $800 in rent, so minus $800. Utilities were $580, so minus $580. He had an interest payment on the loans, which was $100, so minus $100. And then miscellaneous expenses of $420, so minus $420. Now, where are we going to record all that? Well, if you notice, up in paid expenses, that's going to come out of our cash. So our paid expenses under cash will just be the sum of those. So I'm going to put a little formula, equals sum. I'm going to select those cells, and that's it. So we paid expenses in cash of $4,690. Now, of course, in our balance sheet, we have to balance that out. So where is it going to come from? Well, it's not a liability or anything like that. It's going to come out of our earnings because, patients pay us, or insurance companies reimburse us, a combination of both. Those are our earnings. So our expenses are going to come out of those earnings. So we're going to reduce our retained earnings by $4,690. And there we go. So we have the OK sign, so our balance sheet is now balanced. And if you look at our statement of cash flows, we have a cash operating outflow of $4,690, which should make sense. That's what we just paid our expenses out of. Okay, so we're down to our last transaction, and that is at the end of the month, Dr. Landry, as the owner, pays himself a cash dividend. So in this month, he's going to pay himself a cash dividend of $1,200. And let's go ahead and record that. So we're going to have cash minus $1,200. Now, we know that has to balance out on our balance sheet, but where's it going to come out of? Is it a liability? Well, nope. Is he selling any stock in the company? No. So, where does this cash come from? Well, since a cash dividend is actually just a distribution of earnings, it comes out of our retained earnings. So we're going to have minus $1,200 out of our retained earnings. That's how we're going to pay that dividend. And if you see the OK, we're all balanced out. And if you look at our statement of cash flows, you will see a financing cash outflow of $1,200. And remember, a dividend is not an expense. It is merely a distribution of earnings to owners or stockholders in the company. It's a financing cash outflow. Okay, so we're actually done with all of our transactions. That's just review our balances and see how everything turned out. Now, if you look at our balances as of November 30th, we have cash of $7,730. Now let's go down to our statement of cash flows. We began with $73.20, And then once we add and subtract all of our cash inflows and outflows, we had a net increase in cash of $410. So we add that to our beginning balance, and we end up with $7,703, which is another check that's built into our integrated financial statement. So that cash balance under cash flows should be the same as the cash balance under assets, because those are the same thing. So that's another way we can check to make sure we're doing everything properly. Now our accounts receivable is $1,900, so the insurance company still owes us for $1,900 worth of stuff we've billed them. We have our prepaid insurance of $8,400, and again, that's insurance we've paid for that will last us 2 years and 6 years respectively. Now, 1 month from now, will those still be worth $2,400 and $6,000? No, because we will have used up part of that prepaid insurance. So when we talk about adjustments in the next video, we're going to be dealing with stuff like that. But for now, it's just as it is recorded it of $8,400. Our supplies, we still have our $240 worth of supplies. Of course, we paid off $100 worth of those, but the supplies themselves still have a value of $240. We have our $8,500 in office equipment. Now, of course, we paid for some of that out of cash, but that doesn't change the value of the equipment. It's still $8,500. Now, later on, we'll talk about depreciation, and the value of equipment will go down over time. But for now, since we're only worried about this 1 month, it's just going to be what we paid for it. And our land, we're just assuming that it's the same too, so our land is still worth $12,000. Now, as far as our liabilities go, we have basically 2 loans. We have the loan on our land for $10,000 under notes payable, and we have the balance of our office equipment purchase, which was $6,800. And those are longer-term payments we have to make on those 2 assets. So that's why they're under notes payable. Under accounts payable, we have $140. That's because we've already paid off $100 of our $240 equipment purchase. In unearned revenue, we have $1,800. Because remember, we are obligated to have our partner company use our land as a parking lot. Now, will this stay the same over time? No, because after a month, some of that unearned revenue will turn into earned revenue because we have allowed them to use our land for the lot for the month. Now, as far as capital stock goes, we have the $6,000 investment from Dr. Landry that we had at the beginning. During this month, he invested $5,000 more, so his capital stock in the company is now worth $11,000. Now, as far as retained earnings go, we started with $3,320 at the beginning of the month. We had some revenue from fees earned on account via insurance. We had some fees earned for cash in the office, and we paid some expenses out of our earnings of a little bit under $4,700. Those were our expenses on our income statement. And then we had a cash dividend out to Dr. Landry of $1,200. So at the end, we had retained earnings of $9,030. So once we balance all that out, we're good to go because our assets equal our liabilities plus our equity. Now, on the income statement, we have our 2 revenue streams. We have the fees we earned on account that we're still waiting for some of from the insurance company. We have the $5,500 we earned in cash. So those are our 2 revenue streams. We had some expenses that you would normally occur in a business over a month. So when we net all that out, we had a net income of $6,910. Now, think about that and look at the comparison. Our net income was almost $7,000. But if we go over to our statement of cash flows, our cash only increased by a net amount of $410. Because there are some things that didn't involve cash. Transaction E and G did not involve cash at all. So that's what we mean by accrual accounting. We had to separate the cash portion of the business, the cash inflow and outflow from when revenue or expenses are actually incurred. And we have to keep that in mind as we get to our next topic, which is how to make adjustments for certain transactions that are going to either increase or decrease in value over time. Say like our insurance, our prepaid insurance, the prepaid part will decrease over time because we're kind of using it up. Okay, so we have to account for that as the months go by. And again, that's part of accrual accounting. All right, so let's go back into PowerPoint and finish up this video. All right, so that was one heck of a spreadsheet, I know, but it really hopefully gave you a great idea about how accrual accounting works and how cash accounting works and the difference between them, and how all the financial statements are integrated. Just a quick review. For cash accounting, it's very simple. Revenues are only when cash comes in. Expenses are only when cash goes out. There are no adjustments we have to make because things decrease in value or anything like that, or increase in value over time. In accrual accounting, our revenue is when the actual service is performed. So again, if you think back to the lawn mowing example with a neighborhood kid that mows lawns, if you use accrual accounting, at the end of the day, he had or she had $50 in revenue. But for cash accounting, it was only $25 because that's all they came home with. And likewise, expenses are incurred when generating that revenue. So we match the expense to the actual revenue. And we have to make certain adjustments. So that's just the basic idea between the two. Most businesses use accrual accounting, of course, but there are some small businesses that stick to cash accounting because it is simpler. It's easier to manage. You don't have to make any adjustments. It works basically like a big checkbook. Just cash in, cash out. All right, so that was a pretty long video, but for this kind of topic, we have to go into depth so you can really see how it works. So again, thank you very much for watching, and I look forward to seeing you again next time when we talk about how to make adjustments in financial statements using accrual accounting.